Joining us now is Willie Walker, Walker and Dunlop's chairman and CEO, and somebody we rely on to give us some perspective. Obviously, 3 years ago, we started talking about work from home and everything else, Willie. Now we're in this mini banking crisis where everybody's looking at the commercial real estate on banks' books, mortgages, so to speak, that were obviously given at much lower rates. You know, how much of a concern, broadly speaking, let's just start there, is it for you in terms of the credit quality of that commercial real estate and the relationship between the banks that have offered it and what they will be doing if, in fact, some of it comes back on their balance sheet, so to speak?
So good morning, David. It's great to see you. I think you got to look at it in two ways. One, listening to you and Kramer talking about the banking sector and whether we're going to have other failures in the banking system. As it relates to commercial real estate, I think you have to, the question that's being asked right now is commercial real estate going to cause another bank failure? And JP Morgan came out with a research report last week stressing banks across the system as it relates to their CRE, commercial real estate exposure, and took some really significant loss severities on their office portfolios as well as their retail portfolios if we go into a recession, because that would be the next asset class to get hit if we end up in a recession. And the net of that report, David, is this. It's an earnings issue to banks. It's not a solvency issue. And so from a Tier 1 capital ratio standpoint, you could have significant defaults in CRE portfolios, and it's not a solvency issue, unless obviously you get a run on the bank. But barring a run on the bank, this is not a solvency issue. It's really just an earnings issue.
Meaning what, then? Meaning that we can weather this crisis? You know, what is it? I think $1.5 trillion comes due over the next 3 years. You're not concerned? Or let me put it a different way. How concerned are you?
So there really isn't liquidity today, David, for office. Okay, so as Diana said in the piece this morning, 80 billion of office loans term in 2023. So finding capital to refinance those loans is wildly challenging right now. So what ends up happening is the owners of the property have to go put more equity into the properties, and then lenders come back with what are now exorbitant rates to get those properties refinanced. The issue with it is though that's not a systemic issue. Everyone's trying to figure out whether, in the JP Morgan research report, David, they had office, 20% of office loans defaulting in their scenario, in their stress test. And even when you have 20% of all outstanding office loans default over the next 3 years, you still, again, don't get into big degradation in Tier 1 capital. You do get an earnings issue, but even in their most highly stressed, most highly concentrated bank, it's a 10% pre-provision earnings hit. And so, again, the bottom line is banks right now have to figure out, are we going to restructure these loans and allow the owners to continue to operate them, or are we going to foreclose? The issue on foreclosure is you foreclosed on an asset. Now what are you going to do with it? Because there is not a liquid market to go sell it and get 60 cents on the dollar on their loan.
But a lot of these restructurings, Willie, are going to require, it would seem, new money to come in some way. We talk often about Class B office buildings that really don't seem to have a great future unless there's a way to actually convert them to residential, which costs a lot, which requires the local municipality perhaps to offer tax breaks. Isn't that going to have to be a part of sort of this entire conversation?
It is. There are plenty of properties, as Diana just pointed out, that are getting converted. The big issue for major MSAs where you have the real issues right now, I mean, you look at the 3 highest occupancy or vacancy rates in office today. They are Houston, Dallas, and San Francisco. In those major MSAs, most of those office buildings are large footprint office buildings. So when you've got a 20,000 square foot footprint, you can't put residential into that because people need windows, just from a safety and soundness standpoint, much less what they actually want to live in. And so the larger the footprint, the harder it is to convert to multi. And so really it's much smaller office buildings that are projects to be converted. And there are plenty of those going on across the country. But as Diana said, that's not going to save the industry. You're going to have banks come in and rework these loans. You're going to have the special servicers in CMBS work with them. But one of the other pieces to it, David, that's important to remember is, you know, the Wall Street Journal loves to put on the front page that Brookfield or Blackstone has defaulted on an office loan. But in CMBS pools, which is the leading indicator here, because we really don't know about bank balance sheets nearly as clearly as we do in CMBS, office delinquencies are still below 3%. And so the asset class is still performing very well. And so while everyone's trying to find that canary in the coal mine as it relates to what this impact might be, those office loans that were done by CMBS were lower leverage with higher debt service coverage than CMBS 1.0. And so you still have over 2 times debt service coverage on those office CMBS loans. So working them out, is really the only thing to do.